Hey everyone, welcome back to another dividend investing video. We've seen a lot of quality dividend stocks drop recently in their price, particularly in consumer products, real estate, and utilities. And I think the time has come to add another stock or two into the mix in my dividend growth income portfolio. So this is an account I hold with Fidelity that I've been investing in every week for the last year, and I've shared my activity in this account right here on the channel. So my goal for this video is to go through 3 different stocks. Each one are candidates to be added into this portfolio, and I could add just one of them, or I could add all 3. I'm actually making this video to help myself come to a decision, one way or the other, and at the same time provide you guys with some options that I think belong on any dividend growth investor's watch list. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. So first, real quick, I want to establish some criteria I've set for the stocks I'm considering adding to my portfolio. Just some guidelines, basic things I want to see at a minimum to help make sure this investment is worthy of my money. Here they are. First, I want to see the PE ratio at least 10% below its 5-year average. I want to see its dividend yield 10% greater than its 5-year average, although I don't really care whether it yields 1%, 2%, 3% at this point in the game, just relative to itself. Third, I want to see a Simply Safe dividend safety score of 70 or higher. This makes it much less likely it will see a dividend cut. Fourth, I want a dividend growth track record of at least 10 years or more. And finally, I want the 5-year average annual dividend growth rate to be greater than 6%. I'd like to see it in the high single digits or even better in the double digits. So I want above average dividend growth. And guys, one more interesting thing I discovered is that only 30% of you are actually subscribed to the channel here. Guys, I'm really pushing hard to hit that 20,000 subscriber mark before Halloween. So if you aren't subscribed yet, please do so. And if you are subscribed, consider sharing this video with a friend, or hey, even an enemy you think could find value in what we are doing here. We're just trying to spread the love here. Thank you. Stock number 1 I'm looking at is McDonald's, ticker MCD. So why do I want to add McDonald's? Well, I'd like to bump up my exposure to the consumer discretionary stocks in this particular portfolio, which right now makes up less than 5% of the portfolio. And McDonald's is exactly the kind of company that belongs in a dividend growth portfolio like this. And if you live anywhere in the civilized world, I don't need to tell you what McDonald's is. No introduction required. They've been around forever and are an iconic brand known for their tasty and affordable food offered in their restaurants all over the globe. In the last month, shares are down over 11%. Dips like this don't come often, and thus far, they've always recovered from these sorts of drops to reach new highs. Over the last 10 years, on a total return basis, an investment in McDonald's produced superior returns to that of the S&P 500, bringing back 242% between dividends and price appreciation over the last decade. The shares of McDonald's are trading at a forward PE of 21.1. And guys, this is a 17% discount to the 5-year average PE of 25.4, meeting our first criteria. And then by dividend yield theory, we are also looking undervalued. The forward yield of 2.69% is 18% above the 5-year average of 2.28%, meeting my second criteria. The dividend is paid out quarterly in the months of March, June, September, and December in the amount of $1.67 per share for a total annual payout of $6.68. And you have until November 30th to get the next dividend payment on December 15th. The dividend currently makes up 57% of forward earnings, 53% of forward free cash flow. While Simply Safe Dividends considers this to be edging high, these payout ratios are on the lower side of where McDonald's typically runs, especially on the free cash flow side of things. Really, McDonald's has been a free cash flow machine in recent years. And Simply Safe Dividends assigns a safety score of 77 to McDonald's dividend, rating it very safe, suggesting a dividend cut is unlikely, meeting our third criteria. Now, on to dividend growth. McDonald's has a 46-year track record of raising its dividend. Pretty incredible, right? And this easily meets my fourth criteria, because look, in a few years, we're going to have a video coming out about how McDonald's just claimed its dividend king status. With a 5-year average annual dividend growth rate at 8%, this meets my final criteria for a dividend that is growing at a healthy rate. It appears to remain sustainable. I mean, check out this free cash flow per share graph. The growth, their free cash flow per share has nearly tripled over the last 10 years, and this allows McDonald's to continue growing that dividend. Then when you take a look at shares outstanding, that last graph looks even more impressive, as McDonald's has reduced its share count by about 24-25% over the last decade, going from over 1 billion shares outstanding in 2013 to 736 million shares outstanding at the time of publishing. Another thing, the McDonald's acts like a landlord to their franchises, making this somewhat of a real estate investment as well. Analysts have set an average price target of $325.18. This represents 31% upside from where shares trade today. This is one of the only restaurant stocks I could see myself owning right now and buying. I do own Starbucks in another portfolio, an older one, which is another solid dividend growth stock. And I also think maybe Texas Roadhouse also represents a compelling long-term investment if you look into that one too. But right now, I'm really heavily considering adding McDonald's to the portfolio. Well, I think the stock could drop some more here in the short term. I'm confident that it's going to continue to be a solid long-term winning investment. And right now, it's as appealing as it's been in several years. So the next stock that I'm considering looking at adding to my portfolio, Hershey's, ticker HSY. So why Hershey's? Look, I think they're one of the top consumer staple companies for dividend growth investors, and they've long checked off basically all of my boxes for an investment other than valuation. But now things have gotten interesting. In this portfolio, consumer staples takes up 9.5% of the weight out of the holdings. So I'm doing all right in this category. This is one of the best sectors for dividend stocks. So I'm okay going heavier in this particular sector, but I don't necessarily have a need to bump it up, right? I also hold a very similar Mondelez International, which over the last year has been at a more reasonable valuation, another solid dividend growth stock in its own right. But today we're going to take a closer look at Hershey's. So it's been a rough month for Hershey's. The stock price has tanked just 9% in the last month. Year-to-date shares have sank nearly 16%. Today's shares are not far off of their 52-week low, and the big question is, how much lower will this go? The 10-year chart shows that Hershey's investors have brought in 153% on a 10-year investment between dividends and price appreciation. That's total return, right? This does underperform the S&P 500, but for the majority of the time, it was actually outperforming the broader market until this recent drop brought it under. And as a defensive stock, we look at Hershey's more for their dependability, its low beta, but respectable long-term performance here for a packaged food company. And checking in on that PE ratio is at 19.2. It's a 21% discount to the 5-year average PE of 24.3. So Hershey's valuation has come down quite a ways, and the lowest we've found it in 5 years. And it's checking off that first criteria. Okay, and then the dividend yield theory question, we check that criteria as well. So Hershey's dividend is 23% above its 5-year average at a 2.5% yield. Nice. Hershey's pays out that dividend quarterly. The very common March, June, September, December payout schedule, paying just shy of $1.20 per share for a total annual payout of $4.77 per share. The Hershey's dividend takes up 48% of forward earnings and 63% of forward free cash flow. Both look good as they're below that 70% preference that Simply Safe Dividend suggests for consumer staples. So as long as it's below that number, there's no real red flags. Simply Safe Dividends does give Hershey's a very safe score rated 93, suggesting a dividend cut is extremely unlikely and meeting our third criteria for stocks that I'd like to add to this portfolio. And Hershey's features 13 consecutive years of dividend growth, meeting our fourth criteria, and actually 34 years without reducing the dividend. So no cut was maintained in that last recession over 2009, 2010 it looks like. So that's not great, but it wasn't cut, right? Dividend growth is excellent here, right? Hershey's latest raise was at 15% back in July. The 5-year average annual dividend growth rate is 9%. And that checks off our final criteria. So Hershey's is steadily increasing its revenue year over year. Back in 2013, they brought in $7.15 billion in sales. Well, in the last 12 months, they've brought in $10.9 billion. They've also done a solid job increasing their earnings per share and their free cash flow per share over the last decade. Free cash flow not quite as steady and consistent, but the trend is definitely in the right direction that you want to see. And you have a return on invested capital at 26%. It's a good sign of a well-managed firm that's able to create long-term growth in earnings and higher returns for investors. And the average analyst price target, if you happen to care about this stuff, for Hershey's is $244.48, and this represents over 28% upside from where shares are trading at the time of publishing this video. So opportunities don't come like this often. Hershey's, another iconic brand, the stock looking just as tasty as those chocolates, and I'm considering adding it to the portfolio. All right, another stock I'm considering adding to my portfolio is American States Water, ticker AWR. So why American States Water? So right now I just have one utility stock in this portfolio, and that is NextEra Energy, ticker NEE. And that company has struggled lately, and while I still believe in the company, I have no intention of selling, I do think it would make sense to add a second utility into the mix. So right now, utilities take up 4% of the weight in this portfolio. And I don't think I want it to go that much higher. So if I started buying into it, it would be slower than either a McDonald's or a Hershey's. Just not an industry I want to be heavy in. But I do want to perhaps diversify beyond just NEE. American States Water provides water and electric services to residential, commercial, industrial, and other U.S. customers. And their shares have dropped a little less than 5% over the last month, so not as harsh as some of the others. Year-to-date, shares have dropped 17%, as most utilities have dropped in 2023. Today's shares are not far off that 52-week low of about $75. So let's zoom out. It's good to see what the last decade has done. Here we have a utility company that does beat the S&P 500 on a total return basis over the last 10 years with a 242% total return. That's impressive. AWR's forward PE at the time of publishing is 28.2. It's about as low as it's been in the last 5 years and 15% below the 5-year average of 33.4, checking off that first criteria box. Let's look at the dividend yield theory today. Shares of AWR are yielding 2.19%. This is 31% above the 5-year average yield of 1.67%, meeting our second criteria, right? There have not been really many opportunities to grab AWR at above a 2% yield, so this is noteworthy. AWR pays out quarterly in those months of March, June, September, and December in the amount of 43 cents per share for a total annual payout of $1.72 per share. As percentage of earnings paid, the dividend takes up 62%. As long as this is below 75% for water utilities, that looks perfectly fine, A-OK. Simply Safe Dividends gives American States Water a dividend safety score of 98. So this has the strongest score out of the three I'm looking at. Very safe, making a dividend cut look extremely unlikely and meeting our third criteria. The American States Water has been increasing that dividend every year for a mind-blowing 68 years, so longer than the majority of us have been alive, making them a dividend king, checking off our fourth criteria. The 5-year average annual dividend growth rate is 9%. Nice above average dividend growth rate that satisfies that final criteria, very strong for a utility. While AWR is not aggressively buying back shares, they're not issuing them either, or at least they haven't in the last 10 years. And that's a good sign, as utilities will often get away with issuing shares more often to raise capital. Now, AWR has an average analyst price target of $90.67. This will provide over 15% upside from where shares trade today. So AWR looks like one of the more solid, sensible choices out of the utility sector for dividend growth investors. Kind of a boring sector, but boring equals cash flow, and there's predictability to the cash flow of companies like this. There's a lot of appeal for income-minded folks. Out of this group, which of the three would you most likely have in your portfolio if you could only pick one of them right now? Or would you pick none of them? Do you not like any of my choices? I'd like to hear some feedback. Let's have a friendly discussion. Now, if you guys are interested in seeing some other stocks I'm buying in the month of October, go ahead and click into this next video. Lots of stocks have gotten compelling in the last few months, and I'm here for it. I have my plan. I'm sticking to it. Thank you so much, my friends. And until next time, keep investing.